Welcome. Subscribe to AS Foundation, India's leading academy for CA course, and hit the bell icon to get the latest updates. Thank you.
Okay, come to the next paragraph. Right now the topic is what are the steps these companies, credit rating companies do. We have discussed different types of risk. We have discussed business risk. We have discussed interest rate risk. What other things they look into? So the next thing is they look into is management evaluation. Success of a business depends on fill in the blanks. Management, man, material, money, land, capital, all these are brought into action by the management. So if the management is efficient, company will prosper, they'll make profit. But if management is inefficient, of course the company will not be able to generate adequate return for the investors. So one of the tasks of credit rating company is to evaluate the management of the company. In order to evaluate the management of the company, the best way is to see from where will they get the information. The company's management discussion and analysis report, which is called MD&A. Have you heard before it? Where? It is there in your auditing subject, I think. Management discussion and analysis report, which every listed company is compulsorily required to prepare. Now you see, I will show you an annual report of a company called Bosch Limited. Is it Bosch? Have you heard? Now this is their annual report of the year. Which year? 17-18. And there you will find at the top management discussion and analysis, director's report, management discussion and analysis. Okay, and they have written financial result, dividend, economic scenario, global economy, Indian economy, industry structure and development. They are into automobile segment, and I'll just turn the pages. You will see in so much of detail they have written about the performance of the company. There are different operating segments, okay, with lot of pictures, colorful pictures, so that the users and investors can understand. Then financial performance and conditions are given. Audit report, human resource. Okay, you want to see more? Then their manufacturing facilities in different parts like Karnataka, Maharashtra, Rajasthan. Okay, directors and key management personnel, their details they have given. Then a lot of locations where their plants are operating. Performance and evaluation of directors, board meetings, CSR activity, audit committee, subsidiaries, then so many other details they have given. If you are interested, you can check this on the website of this company, Bosch Limited. Okay, so almost you can see 20 pages are there, maybe more. The purpose is they will give you an idea about the function of the management, performance, and how do the management visualize their business in the coming year. Of course, if the management is good enough, you can find lot of information from this management discussion and analysis. And in a listed company, it is compulsory. Even for unlisted companies, the credit rating companies can influence the companies to include MDA management discussion and analysis in their annual report. They can ask the management, you prepare this report for us. So what is MD&A? Is a section of the company's annual report in which management provides a summary of the previous year's operation and how the company has performed financially. I have just now shown you one company. Management also gives an outline for the next year. That means it is future oriented also by highlighting future plans. But of course it is written briefly because they can't dilute a lot of business secrecy in the report, and some brief about the new projects to be launched by the company. So if you see the annual report of a company, any new project they are coming up with is given in the director's report. Next thing the analyst will evaluate, the credit rating analyst will evaluate, is the business environment analysis. One of the factors affecting business performance is the environment in which the business operate. Okay, it means understanding the competition, technology, global scenario, government policies, substitute products, okay, and then keeping all these factors in mind, how this business is going to perform in the years to come. That is called business environment analysis. If you become analyst in a credit rating company or an equity research company, you also have to do it. So what are the factors they examine here? So they will keep an eyes on the laws, LAWS laws, which might influence the business. Example, some examples, as you know, Companies Act 2013 is very different from the previous Act 1956. SEBI's laws, income tax, GST, insolvency code, okay, will affect the company's business environment. Then new trends which have been emerging, like for example, the recent trend is online business. More and more companies are going online. Walmart has also acquired Flipkart in India so that they can get a big pie, a big share in the online market in India. So latest trend is to shop online. That is a trend. We don't know for how many years it will continue. But this will affect your existing business. Crossword. They sell books. Earlier, if you go to crossword company, say 15 years ago, it was fully crowded. There was no place to sit. There was no discount. If it is printed 500, it means pay 500. But then this Flipkart companies came, Amazon came, Snapdeal and so many. Now you can purchase books online. They give you discount also. They deliver you free of cost also. Is it right? So what would you prefer? Going to a shop or sitting at your home and getting the free delivery? Sitting at home and free delivery. Similarly, the ration shops in India, the kirana shops in India will have a tough time in the years to come. Why? Because so many online grocery and food items companies have come up. Now, as an analyst, I have to see what is this company doing, what is happening in the environment, and is it going to affect positively or negatively? Is it right? And then, as usual, technology. Most of the businesses nowadays, are getting affected by the technology. Suppose you are a kirana shop also. Are you affected by technology? Yes. How? Amazon company, they say you put all the products in our Amazon online pay or basket, whatever, grocery basket, and we will pack it and deliver at your doorstep, and they give you discount also. Which basket? Big basket. Again discount. What will happen? They will lose business. The retail shops, the kirana shops will lose business. Okay. Movie theaters will lose business in future because of Netflix and Amazon. And many Hotstar, for example, I don't watch so many, but I know the example. Okay, so running a movie hall will become an expensive affair. Why? More and more people have access to this Netflix now. You pay 100, 200 rupees per month and you watch all latest movies, shows and everything on your mobile any number of time. Okay, so this is called technology which will affect a business. They've given one example. Battery runs car will affect the business of diesel or petrol based cars. In fact, now they're developing technologies where you don't have to recharge your battery for long hours also, and even on the road itself it will get recharged. So if you are a, say, companies like Maruti Suzuki, which is manufacturing mobile petrol or diesel based cars, they might have a tough time in the next few years. Like in USA, Tesla company has brought lot of revolution in the automobile now. More and more people are using that battery powered Tesla cars. And in India also they are going to bring it in the next 5 to 10 years. That is environmental analysis. The next step in the business environment analysis will be to determine as to how much impact they will have on the business. Will this change in technology, change in customers' trend, will it affect our business and how much? Has the company decided any strategies to take care of these negative changes which are happening? These are the business environment analysis. This much efforts you will have to take before you finalize a credit rating report. Okay, are you willing? Yes, then you join a credit rating company. Next, definite question on this topic, if they ask you, simply they can ask a 4-mark question, write a note on camel model in credit rating. Very popular term in credit rating business, camel. This word camel is actually an acronym. It stands for Capital Asset Management, Earning and Liquidity. Capital, Asset, Management, Earnings and Liquidity, which means the rating agencies focus on these 5 key financial or operational variables. Okay, what are these CAMEL? We'll see one by one now. So in the exam they can ask you, camel stands for dash dash dash. So it stands for these 5 variables. What they look into when they are looking into capital aspect, so they will see composition of retained earning and external funds raised. That means their debt equity ratio. Write in bracket. You have to write something more than other students. What is your debt? What is your equity? In equity, how much is your equity share capital, preference share capital, retained earning? Okay, because this affects risk and return. Fixed dividend component for preference share and fluctuating dividend component for equity share. Then adequacy of long-term funds adjusted to gearing levels, whether your debt equity ratio is adequate or not, and ability of the issuer to raise further borrowing. Can the company raise more money if required? Does it have the necessary ability to raise more money? These are the examples of what they look into capital. Another very important aspect is to look into the quality of the asset, because ultimately what will happen if the company fails? You have an asset and that can be realized to pay the liabilities. So what are the aspects to be looked into? Assets, revenue generating capacity of the existing asset and proposed asset. Suppose you are raising money to purchase asset. Will it generate enough revenue? Then fair value of the asset. What is the fair value or market value? Then what is the technological or physical obsolescence in the asset? Are the asset obsolete or they are into current market conditions? Linkage of asset value to turnover. So you write here, they will search for or calculate asset turnover ratio. In your ratio analysis, you have learned this formula. I will write the formula for you. Sales upon average assets. Higher the ratio, better the performance. Higher the ratio, better. Higher is better. Then consistency, appropriation of methods of depreciation and adequacy of charge to revenue. Whether the company is consistently providing an appropriate amount of depreciation in the P&L account or not. Next is size, aging and recoverability of monetary asset, namely receivables, and its linkage with turnover. Some company may have receivable in the balance sheet. So what do? They do the receivable age analysis. What is age analysis? Like you do in your office, 30 to 60 days old debtors, 60 to 90 days, 90 to 180 days, because they want to see which has more concentration. Suppose your credit period is 3 months, means up to 90 days there is no problem. But if you find many debtors are falling in the age bracket of 90 to 180, it means there is a delay in collection. It means your funds are blocked. It means your chances of bad debt is high. Is it right? That is called age analysis. And then recoverability. What is the probability of recovering them? So all this you have to study. Then you have to calculate items like called debtors turnover ratio. Formula I will write for you. Sales upon average debtor. Higher the better. They will compare it with the industry. They will compare it with the peer group. Okay. And then they will understand whether your debtors are overdue or not, reliable or not, realizable or not. There is no point in putting so much asset in the balance sheet if they are not recoverable. One of the most important things they look into is the quality of the management. If a company's management is good, then this company is going to succeed. So they will see the involvement of management personnel in the day-to-day business. Okay, whether one of the board member is acting as a managing director or not, whole-time director or not, CEO or not. Because if they're acting in the company as MD, whole-time director, CEO, they are going to know what is happening in my business. Then teamwork, whether the company's management is working as a team, their authority, timeliness, effectiveness and appropriateness of decision making, along with directing management to achieve corporate goals. A lot of subjectivity is involved, and that is why you have to do a lot of analysis. Continuously see their past track record, see how many board meetings they are attending. In that audit or that management report I had shown you, it was written there, number of board meetings attended. That shows the seriousness of a board member. Out of 6 board meetings, he has attended only 1 or 2. He is not very serious. Okay. These are the things you have to check there. What is their power, etc. Again, very important thing they check is earnings. Absolute level means in rupees. And trends means in percentage or other ratios. So which ratio you will check here? Return on capital employed, return on investment, net profit ratio. Okay, net profit ratio. Stability of earning means whether earnings are constant or not. Constant means it should not be same, but it should not be very volatile. Earnings should not be like this. Suppose this is my earning graph. It should not become like this, that sometimes it becomes negative also, sometimes too high. That is a risky situation. If you are into this area for some years, company may go out of business. So stability of earning. Then adaptability to cyclical fluctuation. Business environment is always subject to cyclical fluctuation. Every business will observe this kind of trend. Okay, you will not have a business who are the respective world leaders in their own field. They don't have that kind of graph. Is it right? So are they able to come out of this low and again move to high? That is the adaptability. Then ability of the entity to service existing and additional debt proposed. Question in the exam, they can ask which two ratios credit rating company will use to check the ability of the entity to service existing and additional debt proposed. So here you will say debt service coverage ratio. In one previous chapter we have written the formula, you can check it later. Interest coverage ratio. If you have taken preference dividend, then preference dividend coverage ratio. That means whether the profit is sufficient to pay interest and principal or not in the first case. In second, whether the profit is sufficient to pay interest or not. In third case, whether the profit is sufficient to pay preference dividend or not. Why do you think we teach you ratio analysis in financial management? So that you can analyze. Okay. Because my topic is credit rating. My topic is to check the ability of a company to repay its interest and principal on time or not. And company can pay interest and principal only if it has got adequate earnings. Okay. So you have to write in the exam something more than other student. That company, the analyst will use debt service coverage ratio, interest coverage ratio to evaluate the sufficiency of earnings. Now business can make a lot of profit, no harm. Good. But profit must also be realized in cash. That is the liquidity. Liquidity means ability of the company to meet its obligations on time. Company should have liquid assets to meet its obligations on time. That is liquidity. You may have a lot of asset, but you are defaulting on payment of interest or creditor. ILFS, defaulting. They are not able to pay. Or say for example, Jet Airways not able to pay the salary to their employees. There's a liquidity problem. Many companies in their balance sheet, they are not able to pay the SMEs on time. So therefore the government has put an extra clause in the Schedule 3. Amount due to MSME will be presented separately. That shows that they are not able to pay their short-term obligations on time. If they are not able to pay short-term obligations on time, means their probability of paying interest and installment is low here. So they check liquidity. So there they will see how the company is managing its working capital management. See the corporate policy for stocks and creditor. They will check the management and the ability of the corporate to meet their commitments in the short run. Now this time you will answer which few ratios the management would, the analyst would look into to evaluate the liquidity position of a company. So one is current ratio, right? Quick ratio. Then you can say inventory turnover ratio. If your inventory turnover ratio is very low, it means your inventories are stuck. Okay, you are carrying lot of slow and non-moving items. Debtors turnover ratio means your money is blocked in debtors if it is lower than the standard or the usual in that industry. Creditors turnover ratio. Working capital turnover ratio. Write down in case if they ask you a question that which ratios the analyst would look into to evaluate the liquidity position of a company. Some ratios I have written. Okay, what is your suggestion? There is one more ratio called cash to total asset ratio. How much is your cash and how much is your total asset? This is liquidity. For liquidity, we will not use interest coverage ratio. No. In that case, the cash profit will be calculated and compared with the interest. So there are so many. You can use that also. So this is camel model. What is C? Again, C for capital, A for asset, M for E for elephant, earning, L for lion, liquidity. Good. These 5 experts form the 5 core bases for estimating credit worthiness of an issuer, which leads to the rating of an instrument. So even if you go for an interview in the credit rating company in future, then keep this chapter in mind, read it. I have tried to cover most of the aspect, and you can answer some of the basic questions relating to credit rating companies. And one question they can ask you, what do you mean by camel in credit rating business model? So these are the 5 things. Okay. The rating agencies determine the predominance of positive and negative aspect under each of these 5 categories. So they will give rating for each CAMEL. Some aspect may be positive. Liquidity may be good, but earning may be poor. Corporate governance may be poor. And then they will consider all factors and then take a overall rating decision. Next is rating revision. Can we revise the rating? Yes. Because credit rating is an opinion expressed by a credit rating agency at a given point of time. Underline, given point of time based on information provided by the company and collected by the credit rating agency. But you see, at that point of time, things may be different. Okay. But after 1 year, 2 year, 3 year, 4 years down the line, things may not be the same. Now, SEBI says in a long-term instrument, they have to keep on reviewing their credit rating. Information collected by the company at the time of giving credit is amenable to change. Change is the only constant. In business, changes takes place very fast. All of a sudden, a new competitor has come. A technology has changed completely and your business becomes outdated. Government policy, in the evening they will announce, Bhaiyo or Deshvachiyo, from tomorrow the notes of 2000 rupees is not valid. Whatever 2000 note you have, deposit in the bank account in the next 15 days, otherwise it is useless. It may affect your business. And the credit rating will have to be revised. Is it right? Therefore, credit rating is required to be revised if things changes. Now, next paragraph, we just write a heading, SEBI's role in credit rating. To protect the interest of the investor, SEBI has mandated means compulsory, that every credit rating agency shall, during the lifetime of the security rated by it. You have asked this question today. For how long we have to do the review and revision? Till the lifetime of the securities rated by it. Continuously monitor the rating of such securities and carry out periodic reviews of all the published ratings. Okay, this is SEBI mandatory requirement. Because earlier this rating agency used to check the fees, take the check, and then their task is over. But now they have to be on their toes every time. and they have to revise the rating if required. Okay. Moreover, India Rating and Research, a Fitch Group company, continuously monitor the rating assigned to a particular instrument. There is one example also. In case of any change in the rating so assigned, the India Rating discloses the same through press releases and on its websites. So you'll give a press release. Press release means to all the leading newspaper, you send a notice that this is the rating I am revising, and then on the newspaper or whatever media is that, they will report it to the public in general. On their website they can revise. Because of internet now, the information goes to everybody quickly. And then recent example is CRISIL has updated long-term credit rating of a company called Sterlite Technologies Limited, Sterlite, to CRISIL AA minus or stable from CRISIL A plus, that is watch or developing watch, and also its short-term credit rating have been upgraded to CRISIL A1 plus from CRISIL A1. That means in this example the rating has upgraded, possible. Additionally, CRISIL has removed its rating on bank loan facilities and debt instrument of the company from watch with developing implications, and it has also withdrawn its rating on bonds at the company's request. Why? As there is no amount outstanding against the said instrument. When the instrument itself has been repaid, where is the question of watch and developing implication? So they can revise it. Now one important for you, in future, suppose you like this chapter, you like the activities which is done in the credit rating companies, and to my knowledge this is a very good area for my young chartered accountant students. You can try in CRISIL, ICRA, CARE, Fetch, and there are many other small also. What do they do exactly? The list is all, we have already discussed this on the first page. Do you remember? If you go to the first or the second page of this chapter, we had discussed rating service, point number 2. Is it there, rating service, point number 2? First page of this chapter, paragraph 2. That is what most of these agencies do. So you can just copy paste that answer, copy for whatever they ask, whether it is CRISIL, CARE, ICRA, etc. But we will also again cover some of them. So main paragraph is 2, rating agencies task. So which are the 5 agencies I am going to discuss today? Or so not 5, 3 Indian and 3 foreign credit rating companies I am going to discuss today. Which are the 3 important credit rating companies in India? CRISIL, ICRA, CARE, C-A-R-E. And which are the 3 international popular rating agencies? Standard & Poor, Moody and Fitch. Okay. But these are not the only rating agencies. There are many more coming into market right now. Okay. Like Duff and Phelps is there. And Onicra is there. O-N-I-C-R-A. Credit Suisse. So there are so many. But in our syllabus, in the material, only 6 are mentioned. So I think in the exam also they will highlight only these 6 agencies. So quickly we'll discuss one by one. No need to remember. It's an open book exam. When was CRISIL promoted? 1988. And promoted jointly by India's leading financial institution at that time like ICICI and UTI. And other shareholders include some of the top names in the banking sector like LIC, SBI, SDFC, GIC, Standard and Chartered Bank, Bank of Tokyo, UCO Bank, Canara Bank, Asian Development Banks and others. CRISIL was the first credit rating agency in India. This is a fact-based question. Which is the first credit rating agency in India? CRISIL. Okay. And it is the first listed credit rating agency in India also. Underline both. It is first in both. First rating agency, first listed rating agency. Listed means now its shares are traded on the stock exchange. In case if you want to buy the shares of CRISIL, you can buy that. Okay. In your notes I have done some editing. Institute material does not give you enough information, so I have added some extra lines and paragraphs. So my notes will not here match with ICI material as it is. Some extra information I have added. So CRISIL has grown in size and strength over the years, and it is one of the top 5 globally rated agencies. Top 5 globally rated agencies. First 3 are Standard and Poor and Moody's, Fitch, and then this is 5th. I don't know who is the 4th. Your homework. It has a tie-up with Standard and Poor of USA, holding 10% stake in CRISIL. Why CRISIL has grown so much? Because one world leader in rating, S&P company, is now holding 10% stake in CRISIL. So they have brought all technology and all the procedures. Okay. It has also set up CRIS Risk, a subsidiary. What is the function of CRIS Risk? Underline. In the exam, the question will be CRIS Risk is an, and then you are wondering what is this? It looks like Chris Gale or something. Okay. It is not that. It is a subsidiary of CRISIL for providing, underline, information and related service over the internet, and runs an online news and information service. Internet based company basically. CRISIL's record of rating over 1800 companies and over 3600 specific instrument. I'll tell you this data is little old now. It has rated many more companies than 1800 and many more instrument than 3600, but at least you can understand the size and the magnitude of the task they are doing. And what are the services they are offering? Same services, rating service. Under rating services, it covers rating of debt obligations of Indian companies. It now rates rupee denominated credit instrument. Which are the instrument? They rate long instrument, medium and short term. For example, debenture, deposit, structured obligation, preference share and commercial paper. Structured obligation we will discuss a little later. Okay. The next service they are offering is information service. I have told you, whatever information a particular entity or a company or a government requires, you can approach them and they can prepare a report on that. So it offers corporate research report and the CRISIL 500 index. Then nowadays they are very actively involved in advisory also. What is advisory service? They provide advisory services to government. Like government sometimes want to disinvest a public sector company. Disinvestment, they want to sell a stake in a company. They want to list a PSU. They want to reduce the government stake in that company through buyback. So what they do, they ask these agencies like CRISIL, and then they offer whether government should disinvest, buy back, sell it completely, bring more capital into that company. That is the service they provide. Okay. Then it advises banks and financial institutions. Sometimes banks and financial institutions are approached by some big businessman and he wants 200 crore rupees loan. Should we give the loan? So they will ask CRISIL because it's not a small amount. So bank may not have the necessary expertise in this example to do all the R&D that is required to give a loan of this amount. So in this case, the big rating agencies, because they have all the resources to do that much analysis, they are given this task and they give the advisory to the banks and others. Then it provides counseling on aspects such as privatization of PSU. Whether government should privatize a PSU. Now that's a difficult question. It has financial, legal, other implication. CRISIL will advise them. Then debt securitization, credit evaluation and so on. These are the advisory service. And then equity research. This I have discussed in the paragraph number 2 in the beginning. That means they will do all the detailed analysis of a company's profile and advise the client whether you should buy, sell, hold. Once you've understood CRISIL in detail, good news. For other agencies, we will again not invest so much time. The next agency which was formed in India was ICRA, the second rating agency. This started operations in 1991. Which was the first one? CRISIL. When was CRISIL started operation? 1988. This is 1991. And second fact is, it is a second rating agency. True or false? ICRA is the first rating agency in India. False. ICRA is the third rating agency in India. False. Second. And I have written the notes also in that order. First CRISIL, so we have written first. ICRA is second, so I have written second. CARE. Then who are the stakeholders in this leading rating agency? Its major stakeholders are leading financial institutions and banks. And in this ICRA, Moody, one of the biggest rating agencies in the world, through their Indian subsidiary Moody Investment Company India Private Limited, is the single largest shareholders. So ICRA covers over 2,500 instruments. But if you see their website, now it has crossed that number. Okay, every year they are adding more and more hundreds of new instruments they are rating. But it gives you a vision or an idea that thousands of instruments so far they have rated in India. Services provided by ICRA, we will not again discuss. Rating service, same. Advisory service, similar to that. Okay. Then information service, equity research. Four things you have to write every time. Rating, information service, advisory and equity research. Okay. And they also do one extra work called credit assessment. It takes up assignment for credit assessment of companies or undertakings. This you can add in other rating agency also, because they are all similar business model. It takes up assignment for credit assessment of companies or undertaking intending to use the same for obtaining specific line of assistance from commercial bank or financial institution. It means the same. I have told you, a bank has a customer who wants 200 crore rupees of loan. So what this bank does, it goes to a rating agency like ICRA, and this rating agency will do credit assessment of that specific client, and then accordingly they will give the advice. Next is CARE. You will find in your note functions of CARES are not written. Why? Because in the first page, paragraph 2, open first page, para 2 of this chapter, that rating services which are explained is in the context of, it is written there, CARE, same service. Some facts we will see today. It was promoted in 1992, 1 year after ICRA, and it was promoted by IDBI jointly with Canara Bank, UTI, private sector bank, insurance companies. Now, one intelligent question I am going to ask you. Why do you think most of these rating agencies were promoted by banks and financial institutions? Because a lot of people approach banks and financial institutions for credit, borrowing. And then these banks and financial institutions, they need some specialized agency who can help them to do the credit assessment of that client. Is it right? So that is why many of them were promoted by banks, so that investors' faith in the instrument which the companies issue will develop. More and more funds will flow into the financial market. It started operations in October 1993. So it has rated more than 2,500 instruments under its belt and occupies an important position in the rating entities. What about function? Refer page 1 of this chapter, paragraph 2. And then one more agency which is covered in your study notes is Fitch Rating India Private Limited. The Fitch Group is an internationally recognized statistical rating agency. In fact, it is one of the biggest rating agencies in the world, Fitch. It has established its base in India through Fitch Rating India Private Limited, which is a subsidiary, 100% subsidiary of the parent organization. Its credit rating applied to a variety of corporates or issues and is not limited to government, structured financial arrangement and debt instrument. So it rates a wide varieties of instrument. It rates a wide varieties of instrument, what we discussed earlier also. Now there is a line which is common to all four agencies, which is all four agencies as discussed above are recognized by SEBI. Otherwise, what companies will do? They will just hire any small rating agency, pay a big amount of fees, get a AAA rating. So then it is not possible. You have to get the rating done by a recognized agency. Now I am going to discuss again an important aspect of your career, credit rating agencies abroad. These are the three very big credit rating agencies. Sometimes in the news headline also they come. Moody has upgraded India's rating. S&P has downgraded India's rating, etc. And that affects our Indian stock market. That affects our political mood also. Moody's rating affects our mood. If they rate properly, government says yes, now the world has recognized our potential. If they downgrade, they say these agencies are the puppet of US government. They are there to blame our country. They don't understand our potential. Who appoint them? On their own they do it. Or World Bank may be appointing them. Is it right? Global investor want the rating. So many times the rating agencies prepare reports on their own. They don't have to be appointed. Once they prepare the report, they publicize it. So interested candidates can read the reports and take the decision. So Standard and Poor will discuss first. S&P, popularly called S&P, it is one of the biggest rating agencies in the world. This S&P global rating is in the business for last how many years? 150 years. It is the world's leading provider of credit rating. And underline, it is one of the three big credit rating agencies in the world. Which are the other two? Fitch and Moody. Both of them are there in your syllabus. Their credit rating is basically an expression of opinion about the credit quality of a company. That is whether that company is able to meet its financial obligation in time or not. So function is similar to our CRISIL and ICRA and CARE. It is operating in about 28 countries. Now that number must have gone up. So you can just find some time and check on the internet. It is now, I think, more than 40 now. The company issues credit rating for the debt of public and private companies. And other public borrowers, now see, they are also rating the debts issued by government and government entities also. It's not that the government bonds are risk-free. Many European countries, the government bonds have also defaulted. Is it right? Countries like, say, Greek, they have defaulted. They said, we'll pay you afterwards. What can you do? Nothing. Their credit ratings are important not only for the corporates, but also for the government and the financial sector. So your question was who appoint them? Even though nobody appoints, but their credit rating reports are used by corporates. Their credit reports are used by the governments and the entire financial sector. That means people like you with deep pockets, with a lot of money, if they want to invest in a country, they will look into these reports. Serious investor would look into the S&P rating of a country and a company, and then he will put his money. It issues both short-term and long-term credit ratings. Like our companies, S&P ratings, long-term credit ratings are assigned on an alphabetical scale from AAA to D. AAA to D means starting with the best and moving towards the worst. And I am going to discuss their symbols little later. AAA is the highest quality instrument and D is the worst quality instrument. And they revise the ratings very fast also. They are very active. They are very active. Next, rating agency is Fitch. So good news, you have to just remember similar activities and some fact-based thing you have to keep in mind. So it is also one of the 3 top credit rating agency. It is headquartered in both New York and London. Fitch ratings long-term credit ratings are assigned on an alphabetical scale from AAA to D. All three agencies have the same system of rating, so that globally you can compare them. Okay, and then in one of the notes I have written how do they give the rating. So the same is applicable for the other two also. When was this company formed? 1924. It was first introduced in 1924, the rating system, and later adopted and licensed by S&P. Both S&P and Fitch, they use similar rating symbols. So in the exam if they ask you, I have given for one of them, but it is also applicable for S&P, it is also applicable for this Moody. Okay. It's a global leader in financial information service and operates in more than 30 countries. Wherever it is written more than 30 countries, more than 28 countries, these are all subject to changes. Such questions are not asked in the exam also. The reason is that by the time the institute sets a paper, they might set up a subsidiary in another country also. Okay. So don't worry, they will not ask you. Investors use the company's rating as a guide as to which instrument will not default and subsequently yield a solid return. This is a general statement for all credit rating companies. For all credit rating companies, investors look at the rating to check whether there is a likelihood of default. Okay. Fitch offers sovereign credit rating. Now again underline what is sovereign credit rating. In the exam the question would be sovereign credit rating means dash. Option A, rating of private limited company, public limited company, private sector company or government. So the word sovereign is associated with government. Like in the newspaper, if you keep a watch, they will say India's credit rating has been upgraded from this to that. That means now as a country our financial strength have improved and the risk is less and more investor will come and invest in our country. That describe nation's ability to meet its debt obligation. Sovereign credit ratings are available to investors to help give them insight into level of risk associated with investing in a particular country. Okay. Now this is really important as a country, because if your rating is proper by these big rating agencies, that country will attract lot of foreign institutional investment. India has lot of potential left right now because the rating is still to be improved. Rating is still to be improved. It's still at a moderate level, mediocre level. You can further improve it and then you can bring more and more foreign investment into the country. Now I have given you, this is not in the ICI notes, that how do they do the rating. So what they do, they divide the instruments into two categories, investment grade and non-investment grade. Investment grade means at least you can think of investing, risk is okay. But non-investment grade means not worth investing, very high risk. Still, in spite of that, if you want to invest, it is your call. Investment grade means worth investing. So there are 4 categories here. AAA means companies of exceptionally high quality, established company with consistent cash flow. AA means still high quality but slightly more riskier than AAA. And single A means low default risk but slightly more vulnerable to business or economic factors. So highest safety, lower, and then triple B. Here low expectation of default. Business or economic factors could adversely affect the company. These are called investment grade. One can think of investment. Risk is there, but still it is better. Non-investment grade means the risk is very high. Likelihood of default is very high. Ideally, they should not be invested in. But still, your choice. BB. Elevated vulnerability to default risk. More susceptible to adverse shift in business or economic condition. Still financially flexibility. And B means degraded financial situation. Highly speculative. Triple C means real possibility of default. Double C means default is a strong probability. C means default or default like process has begun. And RD, issuer has defaulted on payment. Already there are few defaults. And D means defaulted. So would you invest in a D rated bond? C rated bond? No. These ratings comes at the time of revision. Because initially at the time of issue, if they give this kind of rating, mostly they will not get the investor. But these ratings they give after the instrument has been issued and in the next round of review, etc. And that is where these credit rating companies are set to manipulate. First they give better rating, bring the investment on the table, and later on they degrade. So that will be discussed in next paragraph 12. Wait for that. What was the subprime crisis and the role of credit rating agencies in that? Moody's rating. Third international rating agency is Moody. Okay. Is an important contributor in the global financial market. And this Moody keeps rating India. Okay, they have a lot of attachment with India. Providing credit rating services that helps in the building up of a transparent and integrated financial market. But whether they themselves are transparent is a question mark. That we'll see in the next paragraph 12. This corporation has reported a revenue of $4.2 billion in 2017. It employs 12,600 people worldwide and maintains a presence in 42 countries. Can you see their scale of operation? So it is a leading provider of credit rating service, research, risk analysis. Moody's commitment and expertise contributes to transparent and integrated financial market. These few paragraphs I have added from my side also, because Institute material does not give you too much of information on this Moody. The firm's rating and analysis track debt covering more than 135 sovereign nations. Approximately 5,000 non-financial corporate issuers, 4,000 financial institution issuers, 18,000 public finance issuers, 11,000 structured finance transaction, and 1,000 infrastructure and project finance issuers. So this is their scale of operation. Mind-blowing statistics. Okay, so much work they are doing. And Moody Investor Service rates debt securities in several bond market segments. Which are the debt instrument they are rating? This I have added from my side later. This include government bonds, bonds issued by municipalities in many countries, and of course the corporate bonds. Okay, you will find I have added many extra paragraph in these three international agencies because ICI material was not enough. Now credit rating agencies came under scanner in the US subprime crisis. What is US subprime crisis? We'll discuss now. In USA, around year 2003, 4, 5, 6, 7, it started building up from 2, 3, 4, 5, and it finally busted around 2007 and 8. So that was called subprime crisis. First I'll briefly explain and then we will read, and then 2 paragraphs you have to write also. Wait a minute, don't write. What are you writing? Okay, so he is a Mr. A. He is a driver. He goes to bank. Bank lends him money. Banks are very aggressive because they want to build their portfolio of loan, right? The bank managers' incentives are dependent on how much loan portfolio you have created in this year. They get commission, promotion, etc. So now this Mr. A, the driver, his salary is $4,500 for example. Okay, and he has taken a loan of $2 lakh to buy a house. This house is given as collateral to the bank. This bank, in order to attract more such people, what they do? First few years interest rate is low. Low interest rate in first few years. So even this person thinks I will be able to afford, and high interest rate in later years. So first of all, they have designed a very complicated loan structure for this ordinary person like a driver, maid, okay, a gardener, because these people do not have the ability to repay. But this bank have taken this house of $2 lakh as a collateral. So what bank is thinking, and bank knows that this fellow will not pay. I know this, but at least we will recover the money by selling the house. Then these banks became more greedy. They transferred this advance to SPV. They securitized it. So from their books they removed it. So now their task is over. Okay, they gave the loan, they sold it, they made the profit. What SPV did, it issued different types of instruments to different types of investors. So investors, they have created different types of instrument, which I will say equity instrument, bond, 2 types of bond they have issued. Okay, first, in case of any problem, this bond will be paid. Let us call it bond A. Then out of remaining money, bond B will be paid, and out of remaining money the equity investors will be paid. So who will suffer the loss here? Equity. But the interest rate was also different. Bond A was suppose given 10%, bond B will get 11%, and equity will get the remaining surplus income. Is it right? And then this investor invested. Then this SPV, what it did, it went to an insurance company and it also took an insurance cover of default. Insurance cover of default. The investors are also happy. There is an insurance company, and this insurance company said, I will charge you 1% of the total interest that you are going to earn. So this driver will now pay interest to SPV. Suppose he will pay 10% or say 12%. Then they will pay first to this 11%, this 10%, 1% they will share with the insurance company as a premium. Premium was not fixed. Premium was in the form of a share in the interest, let us say 1%. Insurance company is also happy. Without doing anything, I am getting 1% interest. Over a period of time, this bank has given loan of say $100 billion. Over a period of time, 2002, 3, 4. I am taking one bank as an example, but this was done by many banks. So in USA, the total subprime loan has gone into several trillion. That figure is printed in your note. Several trillions. Mind-blowing number. Several trillion. Those who don't know what is trillion, 1 followed by 12 zeros. And in dollar. Well, if suppose Citibank is giving loan, why will Bank of America remain behind? Is it right? If Bank of America is giving loan, why Standard Chartered Bank or any other bank operating in USA will remain behind? Because everybody found this is important. Everybody thought in this process, in simple terms, that this Mr. A will not pay. We know this, but there is a house. Insurance company also thinks that we will recover the house, recover the money, so we are not going to lose anything from this. But then where is the problem? The problem is that these bonds issued by SPV were given very high rating by the credit rating companies, because these bonds have to be credit rated, no? Credit rating companies, they had this idea that there will be default, because there is specialist. They knew that this driver, this watchman, this maid, this cook, or such people with low income are going to default once the high interest rate starts operating. They knew this, but here they made a problem. They gave a high rating to these bonds. They gave a high rating to this insurance company also. Now, in some books which I have read, I did a lot of analysis on this US subprime crisis. It is said that these agencies knew this problem is there. They should not have been given an investment grade rating only. They should have been given non-investment grade, which we discussed. But from non-investment grade, they have given an investment grade. Investors, they relied upon the rating agency. Okay, they relied upon the rating given to insurance company. The problem further magnified. In USA, there is a concept of hedge fund. Hedge funds are like people who speculate also. In addition to investment, they are big time in speculators. They created derivative on these bonds. As the value of the bond will go up or go down, the value of the derivative will go up and go down. Okay. They took 100 times bigger position than the value of the bond itself. Like some of the big names here is Lehman Brothers, which collapsed in this process. Some Bear Stearns or something, which was also acquired by some other company. Okay. They take big position. They are run by these highly talented MBAs, and they are trained to take the risk. They are trained to make profit. They are asked to make profit for the company equal to 20 times of their salary, so that they will get 2 times, 3 times bonus also. Everybody thought there is a house. There is a house. During this time, what happened? The houses prices started falling in USA because these drivers etc. started defaulting. Banks started repossessing those houses. Now banks had lot of inventories of houses, and there is no buyer for those houses. Who will buy? Is it right? And therefore slowly and slowly the pack of cards started falling. Hedge funds suffered 100 times more loss. Derivative, as you have learned, works both ways. Profit means profit, loss means loss. Sometimes it works on a negative direction. So they started making losses. Insurance companies have to give lot of money to these investors. Okay, SPVs made losses. The equity investors of SPV lost everything. So a company in USA called AIG, now it is a partnership with Tata AIG, but AIG is an American company, big company. They were also on the verge of liquidation, that you don't know. And imagine if an insurance company which have insured millions of people and products, if that goes bankrupt, what will happen to the US economy and the world economy also? Because US is a big time economy. Okay, so because of the defaults committed by banks, institutions, insurance company, corporates, the world has gone into financial crisis at that time. Because now the banks were not willing to lend only. Where will you lend? You don't have money yourself. And you were doubly sure now. Is it right? So lending activity stopped in USA. What is the recession? When there is no money in the market. So much money you lost and you stopped lending. Recession. Then US government gave money to insurance companies, other institutions. The weak companies in that process were either liquidated or merged. So where is the role of credit rating here? The role of credit rating is wherever the rating was involved in this diagram, like insurance companies are also rated, bonds are rated. Okay. So there they have made a fault. I told you on one of the previous lecture that some article student of a credit rating company, like an intern, young intern of 2020, he went to his boss, says, I can see this is going to go haywire in future. I can visualize the future. Boss said, take leave for a half day. Okay, don't bother, we will discuss. And then that book which I have read clearly says that these people were hand in gloves with the management. Okay, they had helped the management in getting good rating, because management used to get huge bonus. You know, in USA the bonus runs into 2, 3, 5, 10, 20 million dollars for the CFO and CEOs. It's a big money. Now write down, or before that I'll read the next paragraph and you can write, and then we'll continue tomorrow. They have been highly criticized for undertaking the risk involved with new complex securities that fueled the USA housing bubble. You understood housing bubble now? Such as mortgage based securities. Then you will be interested in knowing what is mortgage backed securities. MBS. Right. Right, somewhere below in the exam the question will be a mortgage backed security is a, and then there will be 4 options. You have to write this answer. ICI Mattel has one problem. They have used some critical terms without explaining it. So write down, a mortgage backed security is a type of asset backed securities. Asset backed. House is the asset. Okay, if you remember that example I explained, so that you'll read the paragraph and you'll understand easily now. Without that story, you would not have understood. Is a type of asset backed security. Investors were issued security by SPV. It was backed by houses, which is secured by a mortgage or collection of mortgages. Which is secured by a mortgage or a collection of mortgages. One house or many houses. The mortgages are sold to a group of individuals. Means in our example it is the SPV. The mortgages are sold to a group of individuals that securitizes or packages the loans together into a security that investor can buy. Together into a security that investors can buy. Okay. So this SPV issues various types of instrument according to the risk taking ability of the investor, and collateralized debt obligations. USA is known for a lot of innovative financial products. So they created this also, and collateralized debt obligation. What is CDO? It is a type of structured asset backed security. It's a type of this only. It is a type of structured asset backed security. If some loans default, I'll explain this tomorrow. This paragraph you write, I'll explain tomorrow. If some loans default and the cash collected by the CDO is insufficient to pay all of its investor, those in the lowest, most junior tranches suffer the losses first. Those in the lowest or most junior tranches suffer the losses first. What they do? They issue different types of security, this SPV. So this will call tranche 1, tranche 2, tranche 3, tranche 4. First you pay to this. If something remains, pay this. If something remains, pay this. And something remains, pay this. So this is collateralized debt obligation. The person who will suffer the maximum loss will be this one, who is normally an equity investor, normally. But at the same time he gains also maximum. If things go well, who gets the maximum gain? The equity. But if things go worse, he suffers the maximum loss. This has least risk. So interest paid to this is, suppose it, this will be paid 9, this will be paid 11, and equity gets the residual. But if things go wrong, so then this equity will suffer the maximum loss here. So this is called collateralized debt obligation, where the SPV issues different securities to different investor according to their risk taking abilities, gives them different rates of interest, negotiates with them different terms. Okay. So this we will continue tomorrow.